What if you could buy your first home without using your personal savings to pay your closing costs? Now, there are seller credits, lender credits, assistance programs, gift funds, and employer benefits that can potentially cover thousands of dollars of closing costs. So how do you get access to that? Here's how to build a legitimate zero closing cost strategy. Now, many first-time home buyers focus entirely on the down payment. They save 3%, 3.5%, 5% of the purchase price and think they're ready. The lender provides a loan estimate showing thousands of dollars in additional closing costs besides the down payment. Now, those costs can include loan origination fees, appraisal fees, credit report fees, title services, recording fees. There's transfer related charges, prepaid interest, homeowner's insurance that you got to prepay. There's escrow deposits for things like taxes. There's property tax adjustments. And then there's mortgage related fees, commissions, things like that. Now, these closing costs can significantly vary based on the property, the loan, what state that you're buying in, the lender itself, the insurance company, and when you're going to close your loan, also known as the closing date. The good news is that the approved sources may cover some or potentially all of those expenses that I listed. Today, I'll show you 5 legitimate strategies. I'll show you seller concessions, lender credits, down payment and closing cost assistance, gift funds, gift of equity, as well as employer, union, nonprofit, and professional assistance programs. Now, I want you to stay tuned to the end because I'll show you how several of these sources can be combined together to create a zero personal funds closing cost strategy. Now, of course, for those who don't know me, I'm Hiley, also known as Hiley the Credit Renovator. I spent nearly 30 years working in the mortgage industry as a loan officer and as a mortgage underwriter. I've seen many people, fortunately, I've approved many loans allowing people to get into their homes and refinances as well. But I've also seen a lot of folks denied their shot at home ownership due to things like credit. And that's why partially while I got into this space, because not only did so many people get denied, but they didn't even know what to do. They didn't to fix their credit. They didn't know what to do to get a mortgage approval. And so being in that role, I could say, sorry, Charlie, but there was nothing I could do for them. Now I can. So I love to work with folks looking to get mortgage ready so they can get their dream home and have a mortgage application experience, home buying experience that's stress-free, relatively speaking. So we cover a lot of those things that you need to be mortgage ready now before you apply rather than trying to fix it in the middle of the process. So first, let's talk about closing costs and down payments and how they are different. 2 different things. Do not confuse the 2. So the down payment represents your initial equity contribution to the purchase. So this is the down payment is going towards the part of the house that you own free and clear versus the part that's still under that new mortgage you're going to get. This is your equity. Closing costs are expenses related to the transaction, all the fees, because buying real estate is a financial and legal transaction. There's a lot of moving parts that got to get taken care of. All those people that work in order for help you get your loan, they all got to get paid. So the expenses associated with obtaining the loan, closing costs, what you put down is put towards the purchase, minus, other than what you're going to borrow, that's down payment. And remember, we're transferring ownership. So a program that pays your closing costs does not necessarily pay your down payment. So any programs out there, they may help you with one or the other, typically not both. But there are cases where you can get both. Down payment assistance programs may not cover any or all of your closing costs. Now, your official loan estimate that you receive, which is a breakdown of all the costs that are going to be associated with your home purchase, include two different important numbers. First, there's going to be the total closing cost dollar amount, and then there's going to be the estimated cash to close. One is going to, basically, let me tell it to you this way. Your cash to close is going to include the down payment that you got to bring to closing, if what's necessary to put in the deal. It's closing costs that are going to be necessary to put into the deal. And any prepaid expenses, things like you have to pay for your appraisal up front, things like that. Initial escrow deposits, any credits that you get, and we'll get to that in a moment. Deposits already paid when you got started in the transaction, and any adjustments that need to make. We're talking about adjustments, we'll get to that. Now, when someone says, I bought a house with no closing costs, what you want to ask them to get clarity on what their deal was, were the closing costs waived? Were they credited? Were they financed into the loan? Or were they paid by somebody else? Because it could have been any or some of those, combination of them. And so then you say, I can tell you like this. Very rarely do closing costs actually disappear. In other words, the closing costs didn't get eliminated. They may have been paid by somebody or waived, but they don't disappear. So I don't really see a lot of waiving of closing costs. Typically, they are shifted from one to another source, from one source to another, in terms of who's going to be responsible for paying it, or they're going to be paid indirectly through another party or another part of the transaction. And I'll tell you what that means. So the first way is usually you can negotiate seller concessions. So a seller concession is an agreement in which the seller agrees to pay eligible closing costs that would normally be part of you as the buyer's responsibility. And where I say eligible, what I mean by that, lenders don't always allow, they only allow a seller to pay so much. They can only help you out so much. There are limitations on that. Now, depending on the program, the mortgage program, and the transaction, seller credits may help pay for loan origination fees, title and settlement charges, discount points. That's when you prepay to get a lower rate, prepaid taxes, homeowners insurance, initial escrow deposits, and other eligible closing expenses. Now, for FHA financing, HUD, which oversees FHA, currently permits interested parties, sellers, to contribute up to 6% of the sales price of the house. They're saying that the sellers can give you a dollar amount equal to 6% of the purchase price towards eligible borrower closing costs and prepaid items and certain other permitted expenses. For example, the house price is $100,000. HUD would allow the seller to give you up to $6,000 in seller concessions. They could pay, the seller could take some of the proceeds they're going to get from selling the house to pay up to $6,000 of your closing costs. Now, with conventional loans, the limits vary based on certain factors. Things like the occupancy. It's different for owner occupied than it is if you're trying to buy the property as an investment. The loan to value ratio is different. So how much you're putting down, the loan to value is, if you $100,000 house, if you're putting 20% down, you're borrowing 80%, so that's an 80% LTV, loan to value ratio. And so what the seller can give you will depend on that as well. The property type, is different for a single family house than it is for a condo or possibly even a townhome. Mobile homes as well, there's different limitations depending on the program. Now, the actual mortgage program itself, it could be different for a straight purchase versus a 203K, or in the case of conventional, home possible or home ready, which is similar to that, where they're allowing you to purchase and do renovations on the house, fix up the house, all in one loan. The contribution source. Now, it's different when it's seller concessions versus other third parties, say a charity or a state or municipal housing program that might be giving you money towards your down payment, towards your closing costs as well. But the seller credits cannot exceed actual costs. So the seller, even though the seller can go up to 6%, if the total amount of your closing costs that are less than 6%, they can only give you up to the maximum closing costs or 6%, whichever is lesser. Now, if your eligible closing costs were, like, say, $8,000, you generally can't use a $12,000 seller concession and then get $4,000 cash back. That used to happen a long time ago, but those days are long gone. Any unused credits may be lost unless the transaction can be restructured within the rules of the loan. So you could shift and change the purchase price or something like that. But typically, 6% max. And so if they're covering all your closing costs, that's great. Oh, sorry, y'all. I didn't realize my camera was kind of looking crazy there. Now, the seller credit trade-off. Now, the seller may agree to contribute $8,000 in my example, but require a higher purchase price. In other words, they may say, we'll pay your closing costs, but we want our price, not a discounted price. So they may say, we originally started out with, say, $250,000 loan. And then you negotiate a price of $258,000. So instead of $250,000, say $258,000. Now, assuming the house appraises for the $250,000, then they say, okay, instead of $250,000, if you want us to give you $8,000 seller credit, how about you pay $258,000? We give you a seller credit of $8,000. And what that would do is that would reduce the cash you need at closing, but you are potentially financing the higher price in the mortgage, because that means you're going to have a higher loan amount because of that. Now, as I said, the property has to appraise for that higher price, and you have to consider that. Now, here's what, and this is a perfectly legitimate negotiating strategy. It's not a bad idea, just as long as you know the whole cost in there. Now, the Consumer Finance Protection Bureau has an opinion about this, and so I'm going to say this. They warn that even when the buyer does not pay closing costs directly, the cost may be paid indirectly through the higher purchase price. So in a way, you're still paying it, but you're basically baking it into the loan. And so seller concessions tend to be easier to negotiate when the home has been listed for a while, so the seller knows it's been languishing on the market and they're happy for your attention to it. If the seller has sufficient equity, they got to have the equity to be able to pay the closing costs, because again, if they don't, they may not have proceeds to give you. All their proceeds may go to pay off their mortgage. You got to keep in mind that, typically speaking, the market favors buyers in most situations, unless you're in a really hot market and then where people are desperate to buy homes in those areas. Of course, if the property needs minor improvements, then typically you can negotiate a lower sales price and still ask for the concessions, because they know that has an impact on the value. If the seller is otherwise motivated, they job transfer, divorce, things like that, where they really need to get out of the house, that can help you be able to get seller concessions without having to pay a higher sales price. And you have an otherwise strong offer on their house. Now, so don't just ask for a lower price. Ask your lender and your agent whether a seller credit will provide you more immediate value than just having them lower the price. Because if you can get that out-of-pocket money baked into the loan, it may be worth it to you to pay a little higher sales price and keep your money that you have for reserves and things like that. So if you're preparing to buy a home and you want to understand this a little bit deeper, as well as things like the credit, the debt-to-income ratio, down payments, closing costs in detail, and mortgage readiness, I would say best thing to do is join my school community. You'll see a link for it in the description. If you come to the school community, we talk about this stuff all the time. I have free resources and tools there. You can get a lot of information and a lot of other things that can help build up your education and your knowledge and get you mortgage ready and be mentally prepared for the home buying process and understanding it. As well as I have courses there too, and particularly I have a home buyer's education course that you can get through my school community. And you get this, you'll be a real estate expert after taking this course, and it's very nominal price. It's not expensive at all. So, and it's pretty easy to get to. Now, let's discuss the second source, your lender. So, let's talk about lender credits and how they can help pay your closing costs. Now, a lender credit is basically money that the lender provides to offset eligible closing costs. But lender credits are not always free. Now, the Consumer Finance Protection Bureau, a good source that I always use and partner with, especially with filing complaints on credit issues, when creditors are not reporting responsibly and not responding to my requests to clear things off of credit. Consumer Finance Protection Bureau is great. In another video, I'm going to show you how to register for them and how to file complaints if you're for those who want to do that and working on your credit yourself. So be on the lookout for that video. But the CFPB explains that lender credits, this is their opinion of them, lender credits commonly work in exchange for a higher interest rate, because that's the trade-off. You may take a higher interest rate in order for them to pay some of your stuff for you. And it's not necessarily a bad thing. Everybody's thinking, oh, lower rate is higher than the bad rate. It's only if you're paying a high, if you don't want to pay higher rates when you don't have to. Now, if you're paying a slightly higher rate in exchange for something like cash in pocket, this is something you want to consider. So let's think about it this way. You got option A. You got a scenario where they're going to offer you a 6.25% interest rate with no lender credits. And then you got option B. They say, okay, we'll give you a 6.5 rate, but in exchange for that extra quarter point, we'll give you $4,000 lender credit to use towards your closing costs. Now, option B obviously reduces the amount that you need at closing, but that slightly higher interest rate can and will increase your monthly payment and your total interest cost over the loan. But again, it's a long-term trade-off in order to get $4,000 now. Now, which one or the other is the correct choice depends mostly on, do you have the $4,000? And if you do you want to pay the $4,000 that you already have and pay those closing costs out of your own pocket? Now, of course, it depends on how long you expect to keep the mortgage. If you're if you're in a situation where you've already considered refinancing in 2 years because maybe you decided to go with the credit you got instead of working and become more mortgage ready. You got just enough credit, is just good enough to get your approval, but you're not going to get the best rate. So, of course, you may not be looking at a 6.5 or 6.25 scenario. it might be 8.5 or 7.5. But my point is this: if you're looking to refinance in 2 years, maybe you're going to move, maybe a job transfer, and so it may not matter about the long-term interest rate. Get the $4,000 now because you're just going to be refinancing anyway, so you don't have to worry about the long-term interest. You know, how much cash you had, like I said, whether you have the $4,000 to put down or not, and whether you want to, if you have it, whether you want to keep what you have. Of course, the size of the credit, because in this, my example, $4,000, pretty substantial. You may not want to consider that if they're only going to give you a $1,000 credit. Okay, then you have to know, again, looking at the scenarios, what's the actual difference in the payment? I talked about the rate in the credit, but what does that rate give you as a payment versus option A versus option B? So you got to look at that as well, because you want to have a payment that you can live with. Typically, you also think about the qualification limit as well as the likely break-even period. But that's kind of a little complicated. But again, you're looking down the line. Not complicated, but something that people may not necessarily think about. But it is a valid consideration that you want to be clear on. Now, of course, the lender is always going to provide you with a loan estimate, but you can always ask the lender, hey, can you give me 2 loan estimates? One for option A and one for option B, so I can see what everything looks like, and I can go boom, boom, and see which one makes the most sense for me. They're more than happy to do that for you, and the great lenders, like a lot of the partners that I have, they do that for folks anyway because they like to run those scenarios to give you the best options. Now, of course, when you're looking at these 2 options, you're going to compare interest rate to interest rate, monthly principal and interest, because remember, we're just talking about the loan part. Taxes and insurance are not going to be affected by this. They're going to be the same based on what the house is, so we don't have to worry about that part yet. We're going to be looking at the credit itself, option A's credit versus B, in this case, 0 and $4,000. Then we're going to be looking at the total closing costs. Are they going to be different? We're going to be looking at cash to close, a 5-year cost. Again, maybe not matters if you're going to be going in 2 anyway, or your total interest as a percentage. Now, these lender credits should appear on page 2 of the loan estimate or the CD, closing disclosure, and I believe it's section J that you'll see that. Now, you generally do not want to accept a higher rate without calculating what the rate will cost you over time, and that's what a lot of this will tell you. But it's important that you kind of have an apples to oranges comparison and see what your options are. Now, the third way you can get closing costs paid is you use a down payment strategy or a closing cost, assistance program. I'm going to put it that way. That's a general number. They have a lot of different names, but typically you're talking about an assistance program, whether they're going to assist you with the down payment or assist you with closing costs. And so think of it this way. Most states have housing finance agencies. Most cities, counties also have programs. So you may be possible to get money from all of these. And there are many other approved organizations, private organizations, not part of the government, that may offer assistance programs to eligible home buyers. I'm sure a lot of you probably know 1 or 2 that pop in your head wherever you are. But regardless of where you are and which whether state, city, county, or a private program, depending on what their program is, the assistance may be structured in a certain way. It may come to you in the form of a grant, a forgivable second mortgage, that one's very popular, a deferred payment second mortgage, so you don't have to start paying it to some later date. A forgivable one, really great, a low interest second mortgage, a shared equity assistance program, a matching savings program, a targeted neighborhood program, which this one was kind of new to me. I had to actually do a little research to find this one. Now, these are all the programs they got. Now, some of these programs cover down payment. Some of them cover closing costs. Some of them cover only prepaid expenses. Some of them may cover any interest rate reductions like buy downs or paying the points. Some of them will actually start you off. They give you the money and it won't pay closing costs, but it will help with the principal reduction, which is the flip side of down payment. But keep in mind, the word assistance does not always mean free money. That's why I kind of had to think about it for a minute, but I said, no, I'm still going to call it assistance programs. But I'm always concerned because when people see or hear assistance, they think about free money. So let's look at these. The grant. Now, the grant typically will not require repayment, which is why it's called a grant. But you have to keep in mind that many grants, in order for you not to require repayment, you have to meet some requirements for the program. They have to be satisfied. And if you don't, then they'll say, nope, we're going to want repayment at some time in the future. But you have time to meet these requirements. You just have to meet them. And then you don't have to repay anything. It's a true grant. Now, a forgivable loan. This starts out with you understanding that there's a commitment, there's a repayment commitment down the line. However, there'll be requirements in place that if you meet them, they may forgive that loan in the future if you're still eligible and you meet the forgiveness requirements. So a grant typically starts out as non-repayment unless you don't meet future requirements. Forgivable loan is like the inverse. You're starting out assuming you may have to pay, but they give you a way to get it forgiven. Forgivable loan examples. Say the balance may be forgiven gradually over time if you occupy the home during a required period, say 5 years, things like that. So as long as you stay in the house, you're there, and you meet that time commitment, they'll forgive the loan in the future. So in other words, if you sell, refinance, or move too early, it could trigger a repayment of that loan because because a lot of times with those programs, they want people to repopulate a neighborhood that was declining. And so if you commit to the neighborhood and you stay there, they're helping you out. Now, a deferred second mortgage. Sometimes people get confused on this one. Now, a deferred second mortgage, just like a regular second mortgage, you're going to be expected to make payments. However, just like in a deferred student loan, you don't have to make payments right now. The payments usually are postponed, but the balance could become due if you sell, if you refinance, if you transfer the home or pay off the first mortgage in any way, then payments might be due on that second. And so the deferral period ends. Now that versus a repayable second mortgage. Now with a repayable second mortgage, you may have an additional monthly payment that affects your debt to income ratio. So they may say, okay, we know that sometime in the near future, you're going to have to pay extra, say it's $80 a month on that second mortgage. When they're qualifying you for your loan at the beginning, even though you don't have to start paying yet, they still have to count it in your DTI because they know it's going to affect your budget in the near future. So you have to be careful with the repayable seconds because they have to assume you have to pay, and if you can't qualify with that second, you may not be able to get your deal done using a second. You may have to come up with another way to have that down payment assistance. Now, before you accept that assistance, because it sounds great, oh, I'll take it if it'll help me get in my house and less money that I don't have. You want to make sure that it's clear whether your assistance program is a grant or is a loan. Be clear on that. You want to make sure that is there an interest rate associated with that second, because not all seconds in these programs have an interest rate attached to them. It's just straight. You have a second loan with X amount of dollars. They're not charging any interest. No interest is being accrued. But some programs, they do, like a normal second. You want to be clear that is there a monthly payment at calculator or outlined in the program, whether it's forgivable or not later, whether it's deferred later, if there is a actual dollar amount being as part of the deal. What is it, and is there one, and what is it? You want to be clear on how long you have to occupy the property to get that become non-payable. Like I said, no forgiving. Deferment, it could be permanent or it could be temporary. It could, in other words, a deferment could turn into a forgivable loan. You want to be clear on that. If there's any triggers, when would repayment be triggered? Like I talked about before, if you sell, you move, things like that. Are there any income limits? Can you qualify? Because sometimes these programs are designed to help lower income folks, and they may have ceilings, and you want to make sure that when you're trying to put your deal together that you include in a program that you can actually get. Is there a purchase price limit? Because again, a lot of these programs are meant to target certain neighborhoods, and they already know in order for a person to have a choice but yet be in that neighborhood, they may say the limit is $125,000. So that would eliminate any high price neighborhoods or anything like that. A lot of these programs are built and offered primarily for first time home buyers. Now you want to be sure that if that's not the case, that are you eligible for it? If it's built for first time home buyers, and you don't meet that. Most folks do. If you haven't owned a house within the last 3 or 5 years, you still consider, even if you had a house in the past, you can still be considered a first time home buyer again. Yes, I know it's kind of odd, but it's great. Now, is home buyer education required? Now, of course, for those of you who may not be familiar, there are a Fannie Mae certified course. It's very rudimentary. It's very basic. It's more or less to give you some basic about home ownership, and it's a compliance thing that the government has to make sure you're informed to some degree. It's nothing really robust. It's nothing detailed. I have a home buyer's education course. It's not Fannie Mae certified, but you will actually be really educated in real estate, in the real estate buying process, the mortgage lending process, as well as home ownership and costs down the line after you bought your house. Just so you know, shameless plug, I'll admit, but you'll find that in my school community as well. Now, you want to also be clear on which lenders can offer the program, because sometimes if you're interested in this program and you're working with a lender that's not part of the program, you want to be sure up front before you commit to a lender, and you won't be able to take advantage of that. Can the program be combined with the seller credits? Can it be combined with the lender credits? So, again, when I was talking about combining them earlier, if you can get in a house, you get a home buyer's, down payment assistance, you get lender credits, you get seller credits, you could potentially walk away with putting I've seen examples, no BS, I've seen examples in the past where folks have walked away buying a house and they've only paid $12, $13, $20 out of pocket. So it's possible, but of course you got to put all those pieces together. It's important that you search your state housing finance agency, your local housing department agencies, and the HUD approved counseling agencies. They all have resources so that if you start there, they can point you to that so that you'll end up with a loan officer who works for a mortgage company that participates in these programs. You have a realtor that's versed in these programs, so they can educate you rather than you having to figure it out with one that's not familiar with it. Now, I'm going to tell you this. I've created videos. I've talked about grants and things like that. But I can tell you this, those are grants. When I'm talking about grants, there's housing grants in there. And my videos talk about how you can search those out yourself. But again, these housing agencies can do that too. And then I talk about grants for funding. It's a different subject. But my point is this, when it comes to home buying, you don't need to pay a social media grant expert for a secret list that is freely available through official sources like the company, organizations in your state, in your city, and everything to get you grants. You don't have to pay somebody to get those grants. You don't have to pay for the information. There's no need for it. There may be secret lists. I can't say whether they do or don't, but I'm just saying you don't need to pay for a secret list because all the open and available ones that are not secret are right at your fingertips. Now, let's talk about gift funds and the use of gift funds and gift to equity for those of you not familiar with that. Now, eligible families can give you gift funds. They can cover some of your closing costs. Now, certain programs will allow it. There's some that don't, but most mortgage programs allow eligible gift funds to pay for some or all of your down payment, your closing costs, the prepaid expenses we talked about before, and they can be used for any required reserves when needed and when permitted. Now, the important part is about the donor. An acceptable donor depends on the mortgage program because they do have some variations. But potentially eligible donors may include any relatives, blood relatives, domestic partners, fiancés, guardians, legal guardians, parental guardians that maybe you grew up in foster care, that your foster mother or father can give you gift funds if you just can prove the relationship. And there are other approved individuals or entities that can help you. Maybe not, maybe Cousin Pookie can help you. Maybe he can't. It depends on where he at. Now, the lender may require a gift letter. That's usually standard. Donor identification. Of course, we need to see their ID to say, so that we know they are who they say they are. And then evidence of their ability to provide the funds. Now, I know some people get funny. In my experience as a mortgage company, I've seen situations where we ask for these things because someone's relative wanted to donate. And they say, why do they need to see my business? Why do they need to see my bank account? Why do they need to see that? Well, we have to source the money. We got to know that the money that's coming from the donor is really coming from them, not being passed through some secret thing where somebody's trying to hide the source of the money. And we got to know that they're not draining their bank account for that, and then which means they're probably expecting to get repaid back, which is not what a gift is. So me as an underwriter, that's what I looked for and asked for to make sure that this is really what they say it is. And then, of course, we got to see proof of the transfer, that they actually transferred the money to the borrower. Now, they could plan to do it on a certain day, but before final approval, we would want to see that transfer. We would need to see their bank statements. Of course, we're already asking for the borrower's bank statements. You as the borrower already get that. You would have to get an updated statement showing when you received the money, and a letter that's verifying that no repayment is required. It is a true gift. Okay, the gift can't be really a secret loan. Now, if your relative expects any kind of monthly repayment, it's not a true gift. And so it would have to be disclosed as debt and added to your DTI. So make sure that don't try to pull a flim-flam. If it's a true gift, it shouldn't be any problem providing that in exchange to getting that money. You know, don't create fake gift letters to hide borrowed money. Don't try to make loans and look like gifts. And don't try to hide a gift, and, put a loan inside of a gift promise. Now, gift to equity is basically the same thing. All of those requirements are the same. But instead of the relative giving you gift money, A gift of equity happens when the relative that you're getting the gift from is the seller of the house. So you're buying your auntie's house, you're buying your uncle's house, you're buying your cousin's house. So that gift of equity may be available when that eligible. Now, first, they still have to be an eligible family member, just like with the cash gift. And if they're selling the property to you for less than its appraised value, so it can't be an hyperinflated value, a sweetheart deal. Now, I mean, it could be a sweetheart deal in the discount, but not to make it look better for them. So suppose you're buying your parents' house and they own a home, maybe it was a vacation home, second home, or an investment property that they previously already had. Say it's worth $250,000 and they agree to sell it to you for $225,000. They're giving you a $25,000 discount. That $25,000 difference can be treated as a gift of equity under, the right program. Now, Fannie Mae will permit you to have that eligible gift of equity to go towards your down payment, or it could go towards closing costs and prepaid items for qualifying. So it's up to you. You could use it all for down payment, or you could use some of it for down payment, or you could say, oh, we want that to do that. So essentially they're using the gift of equity to pay some of your closing costs, similar to the seller concession thing, but the guidelines are different because this is gift. Remember, seller concessions is capped at 6%. Gift of equity is not capped that way. It can be more, but it will be spread out over closing costs and other things as well. So again, these are all qualifying transactions and these are all qualifying items. Now, FHA's gift to equity rules generally require that the gift to come from an eligible family member. Sometimes some of those other extended people, they may not allow. But as long as it's an eligible family member under their rules, you can use the gift to equity. Now, of course, the property must still be appraised as you normally would. The relationship still got to be documented through the letters and the ID and all that. And the transaction has to be ultimately approved by the lender. Now, a gift of equity is not created by writing any number you want in the contract. It must be real equity supported by the appraisal, and it's got to be a legitimate sales transaction, not a bailout or something like that. Because it gets tougher to do these things when the seller, in the case when it's a gift situation, if the seller is maybe in dire straits, even if they're in delinquency, that may not matter as long as it's not a bailout. A bailout in terms of they're really not buying the property. It's like a straw buy type of situation. Now, this is number 5. This one I don't see a lot of, but they do come about, especially with certain employers that really have some good benefits. So when employers or your union or even a nonprofit can offer money for closing costs or professional assistance in credit. So I'll explain what that means. Now, some employers provide homeownership benefits specifically that can be used towards the housing expenses. So they may have a closing cost grant. They may have a down payment contribution. They may have forgivable loans, relocation benefits, matching funds, home buyers counseling, and preferred lender credits. So you want to ask, your human resource department, does our company offer any kind of employer assisted homeownership benefits for the employees? Are there relocation funds that may not be used for closing costs? Does the company partner with any housing or lending programs? You want to ask these questions. Now, some unions, some professional associations as well, many nonprofits and community organizations also offer assistance. Their programs may target groups like teachers, first responders, healthcare workers, government employees, veterans, active duty service members, employees purchasing their work at the workplace, near the workplace, buyers in designated neighborhoods, or low to moderate income households. So you guys kind of get the gist of that. I don't think need to go into that too much. Now, Freddie Mac, which is similar to Fannie Mae, in case you've never heard of them, they recognize documented employer-assisted programs as potential sources of home purchase funds. And then they're saying they're eligible under mortgage structures, normal mortgage situations. But you have to remember the assistance must be disclosed and approved by the lender. And you want to make sure you don't accept any undocumented money from a business, an agent, builders, or any other third parties, and then try to call it a gift instead of it being a down payment assistance program. The person or organization that's providing the money and the relationship to you as to why they're providing the money must be disclosed, but the relationship matters. So, having said all of that, how do you combine any or all of these 5 strategies in your one deal to try to get as close to zero as possible, or maybe that 12 or 25, 30 bucks that I talked about earlier? Let me give you sort of now this is kind of oversimplified because like just about everything else in mortgage and in credit and things like that, these things can be very complicated and complex. But I'm going to kind of give you a simplified example to illustrate this. Okay, suppose you have closing costs and prepaid expenses total $12,000. Now, your approved sources for your that to go towards that $12,000. Say you got a seller credit of $5,000. Say you got, and I should have had a whiteboard for this to add it up, but I'm hoping you guys can follow along. Suppose you got lender credits of $2,500. Then you got a local home buyers grant for another $2,500. And then you have employer's assistance of $2,000. So $5,000 plus $2,500 plus $2,500, that's $10,000. Then another $2,000, that's total is $12,000. Now in this example, the buyer's eligible closing costs could be fully covered without them using any of their own personal funds out of pocket. But the buyer would still need money for their down payment, any earnest money that they may have had to put down when they made their offer, inspection, appraisal, reserves, any moving costs, any repairs that might need to be done on the house, and unexpected charges. Now, I know a couple of those are not part of the purchase transaction, but they're costs that you got to think about later. Alternately, the approved gift funds or the assistance might be used to cover some of those items if the program that you're using permit that. So you could do that instead of the other costs. So in other words, same money, but you're just applying it in different places. Now, of course, your lender will be best at coordinating the sources and applying them in a place that makes the best deal for you. And then, of course, you always got to think about unexpected changes that can happen. Sometimes that costs you money as well. Do not build this, try to do this stack by yourself. It's always better to do this in advance. Don't surprise the underwriter 3 days before closing because it drives us nuts. Now, how can you muck this up and blow the strategy and mess this whole thing up to where you end up with no seller assistance, no down payment assistance, no closing cost assistance? So usually there's a bunch of mistakes, and I'm going to run through these quick. You guys can figure it out for yourself. Okay, and consider these for yourself, I should say. Negotiating too much seller credit. Don't get greedy. If the credits exceed the eligible cost and cannot be fully used, you're negotiating for too much that you're going to get cut off anyway, and you end up paying too much for the house if you're offering more and try to do that. So don't blow that. Number two, don't trying to raise the price for this thing. Don't do that, and then you end up with a price that is beyond the appraisal. If the home doesn't appraise for the value, that negotiated higher price is just going to create a funding gap, because guess what? When you're borrowing loan for a mortgage, your loan to value ratio is based on the lesser of the purchase price or the appraised values. So if the purchase price is $100,000, so if the purchase price is $250,000, appraised value is only $245,000, you're not going to be able to go higher than $245,000 minus whatever your down payment is. So remember, know that the value is there before you try to do that. Otherwise, you'll create a funding gap for yourself. Mistake number three, accepting an unaffordable lender credit rate, because that higher monthly payment pushes your DTI beyond the qualification limit, and now you've done all this negotiating just to create a deal that you can't even qualify for. So you want to be careful of that. Number four, assuming that assistance is a grant when in fact it may be a loan. Now, it even may be a forgivable loan, but a forgivable loan may end up with the same outcome as a grant, but you have to get through those hoops first. So you got to meet all those future requirements as well as the current one. So, but be clear, when you get down payment assistance, whether it's something that's required to be repaid or not, even if it is, you just want to know all of the requirements. Number five, using undocumented cash. That's a no-no. In mortgage world, we call your funds have to be sourced. We need to know where they came from, and they have to be seasoned, except for gift funds, because you can get the gift funds near closing, just before closing. But all your other down payment and money that's going to come from your closing costs, we need 2 months bank statements to show that this money didn't just come out of nowhere last week. We need to know you had this money at least 60 days prior to closing. And then we need to know where it came from. So if the lender can't verify the source of this money, these down payment assistance, all this money's got to be traced. And if they can't trace it, the down payment programs don't have to be seasoned, but other money do. But it always got to be sourced. We got to know where this money is coming from, and we want that paper trail. Number 6, changing jobs, opening up new credit, or spending reserves. Now, I know that's outside of what we're talking about with assistance credits, but this is another thing that can blow your deal. If you change jobs right in the middle of the loan process, that could create problems. If you open up new credit and take on new debt and it changes your DTI and then now you're over, that could blow your deal. Or spending your reserves when you're required to have those. The reserves is money you got to have as emergency payments that you want to show the lender. In case something go wrong, I got some money set aside to make my payments so I won't end up in default too early. That can blow your approval as well. Forgetting about any upfront expenses. If you don't have money for your inspections or your earnest money deposit, your appraisal, or maybe even your insurance binder, that's when you get your property insurance and you go and you get an estimate from your insurance company at State Farm, Allstate, Progressive, any of those guys, Farmers. And then they say, okay, we need you to pay for the binder, saying that we commit to the quote we gave you and the coverage we're offering you, and you're committing to buying it when your loan transaction goes through. And then lastly, spending every available dollar you have. Don't do it. Don't be in a hurry. Sometimes people that get excited about the prospect of a new home, then they go out and they start buying furniture and all other kinds of stuff. Furniture for the inside of the house, furniture for outside the house, patio, temporary swimming pool, and things like that before they've even gotten the final approval on the house. And so you don't want to do that and blow the deal. Or say you close on the house, But then now you find yourself with no emergency fund. You get so don't think that because you got a zero personal funds closing is not financially safe. Hopefully, if you got reserves and other money set aside, that's your emergency. And if none is required for the deal, you at least require it for yourself. So you got a cushion in case, just in case. Because I've seen everything. I've seen people lose their job right after buying a house. I've seen people be in a car accident or have a family member suddenly fall ill significantly with a disease that had an impact on that, even though it might have not even been qualifying income, but it's income they knew was coming in the house for safety purposes, and then now they're in jeopardy because that person fell ill and is off work long term with no coverage for that. So lastly, let me give you a quick zero closing cost action plan. Number one, get mortgage ready. Review your credit, review your income, review your debt, and all your available assets. Step two, request a complete loan estimate from your lender so that you can identify the estimated closing costs and cash to close you're going to need for your house. Step three, you want to ask about assistance before shopping. Some programs require approved lenders, so you may have to go with certain lenders. They require home buyer education, which there's a cost for that. It's typically around $75. And your pre-approval, they may need a pre-approval letter before you sign an actual offer on a house. You want to get the right real estate agent. Your agent should understand all the seller concession programs, how it works, all the assistance program requirements, so that it won't be a blind leading the blind situation. They should be familiar. You want somebody that's familiar with these programs if you're going to be intending to use them. Step five, you want to compare lender credit options. You want to request written estimates and different rates and credit amounts for your lender options like I talked about, 2 different CDs. You want to identify gift and employer resources. You want to document that you're going to be using these early in the process so everybody knows what's going on. When you negotiate the purchase contract, you want to include seller credits and other terms correctly in the process. That's where you want to make sure that your realtor is clear on these things so they can term that right and have the right verbiage in the contract. And then lastly, you want to review the closing disclosure that I talked about, especially the 2 examples, to confirm that every approved credit appears on your CD, your closing disclosure, and verify what your final cash to close is going to be. You want to make sure that you know your estimates, you know your estimated down payment, closing costs. You want to understand the difference between the two. You want to make sure that you receive a loan estimate. You want to ask about the seller credits, the other things that I told you. So, long story short, if you want help preparing your credit, income, debt to income ratio, and home buying budget, I strongly recommend that you join my school community. I have resources there for all of that. That way you can get familiar with these concepts. So when you start having these conversations with realtors and with mortgage lenders and with the folks at many of these community organizations, you can speak, and have some background to speak, quote unquote, intelligently about these things. Not saying you're not intelligent, but you'll understand. In other words, you'll have a lot of the definitions already. So when they speak about these things, you already know what they're talking about. You're just getting the particulars for their program. Now, inside the community, you want buyers. You want to be an aspiring buyer who wants to be mortgage ready. That's where we help. You want to have mortgage ready credit. You want to have a mortgage ready understanding and a mortgage ready mindset. And understand these steps between wanting a home and being financially prepared to actually own one. Now, if you use the link below, you'll go inside and you'll be able to join the group, and then you'll be able to have improved credit. You'll be able to save for closing. We'll show you how to research assistance, like I talked about here. seeking pre-approvals, and shopping for a home. So, can you get your closing costs paid without using personal funds? Absolutely. Potentially, but absolutely. Now, when the transaction, mortgage, and the approved sources support you getting zero, having to bring zero out of pocket, fine. But there's also somewhere in between. Any and all assistance is a great thing, right? I'm sure you wouldn't disagree with that. So with the seller concessions, lender credits, down payment, gift funds, and gift to equity, your employer and union help, those sources can be used individually or combined together. But remember, the closing costs don't disappear. Now, the seller may recover the credit that they're giving you through a higher price. The lender may recover its credits through a higher rate. The assistance program may end up be in the form of a second loan. All of these things are possible, like I said. The gift funds got to be documented, of course, but that shouldn't be anything other than the gift from the family member and the other concerned person to help you in your quest for buying a home. The employer benefits, they got to meet the requirements, of course, but the employer is doing that because you're a valued employee and they offer this program because they want you to be vested. They want you to be a happy employee, and they know when you get a mortgage, you can't afford to quit your job no more, right? Now, in my next video, I'll show you how to read cash to close section of the loan estimate if you want to look at that. That's very interesting. Look, this is dollars, so I'm always paying attention to that. Some people consider it kind of confusing, but I want to cut that out and make it clear to you so that you can easily identify how much money that you need for close. Now, when that pops up, I just want you to click on that, subscribe to my channel. That'd be great too, my YouTube channel, and join us inside the community where we can help you get mortgage ready. Now, you may not need to pay every cost yourself, but you do not need to pay for every dollar either. I'll see you in the next video.